I have the biggest IRS tax court cases that you need to hear about because, okay, the truth is there are some gray areas in tax law that do not explicitly state what or how to take certain tax deductions or handle specific tax situations. And so some people think that, well, they didn't say I couldn't do this. Let me give it a try. But look, if you or your tax preparer are not careful, then you could end up having your income adjusted, owe more in taxes, or even worse, end up in prison. And look, I don't want that to happen to you. That's why I made this video on popular IRS tax court cases that I think everyone should know about to have a better understanding of tax law and what to do, and especially what not to do on their tax return. So what I want to do is cover the IRS tax court cases you need to hear about, how to legally use these tax deductions that I'm going to cover, and the best and worst outcomes of losing an IRS tax court case. And a lot of time went into me making this video with me having to do some extra research and making all of this easy to understand. So if you appreciate a video like this, then all I ever ask for you to do is hit the like button for the YouTube algorithm. It goes a long way in helping this video reach more people like you who need to hear about these tax court cases. Stay tuned. Hey there, and if you're new, welcome to our channel. I'm Sean with Life Accounting, the accounting company that helps you save on taxes and build more wealth. As always, what I'm gonna do is put the timestamps for this video somewhere down in the description below so that you can skip to the parts that you want to learn the most about. But look, all these tax court cases are extremely helpful to know about, especially if you are a business owner or individual. So I recommend watching this entire video. Okay, let's dive in with tax court case number 1, the vehicle tax deduction. Now I'm starting off with this one because this IRS tax court case involves a CPA. Yes, a certified public accountant who got audited and misused the vehicle tax deduction. And look, this is a popular tax write-off used by many business owners who have cars, SUVs, trucks, and other vehicles for business purposes. So let's go ahead and review what happened. So this case is called Kilpatrick versus Commission of Internal Revenue. And if you want, you can find this case on casetext.com if you want to look into it for yourself. But here's the deal. So the CPA took a tax deduction of $22,331 in vehicle expenses, claiming that he drove 40,601 miles for his CPA business. But the IRS audited him and only allowed him to deduct $398 in vehicle expenses. So what exactly did the IRS find? Well, to explain this, let me briefly cover how to legally take almost any tax deduction when you have a business. Okay, you must have two things. Number one, the tax deduction must be ordinary and necessary to the business. Okay, ordinary expense means that it is common and accepted within your industry, and a necessary expense means that it is helpful or appropriate in order for your business to grow. And then number two, you must be able to substantiate that tax deduction. In other words, you must be able to provide an accurate log of when the business expense incurred and then proof the expense was actually used for business purposes. Okay, now that you understand that, let's continue. So the case went to trial and the truth started to come out. So the CPA changed up his story a little bit, and instead of substantiating the 40,601 miles that he claimed on his tax return, he instead came to court claiming only 8,687 business miles. Hey Sean, look, I have 40,000 business miles. What? Never mind. Okay, now to substantiate the vehicle tax expenses he had, the CPA gave a copy of a calendar and printed out MapQuest directions for the court. And he used the MapQuest directions to show the distance between his residence and the various towns that he allegedly traveled to for business purposes. But here's the thing, okay? The CPA put together and prepared the calendar and MapQuest directions 2 years after the business use of the car. Okay, 2 years. And so the court concluded that these were not adequate records and that the evidence provided was not made at or near the time of using the car for business. And in addition, the calendar did not contain other required information such as his business appointments, who he met with, and the overall business purpose of the travel. And so the majority of the CPA's vehicle tax deduction was rejected. So in other words, the case found that the audit was correct because the CPA was not able to substantiate his vehicle tax deduction. And remember, this case involved a CPA, okay, a certified public accountant. So a big lesson here is that you shouldn't blindly take advice from anyone. Okay, just because someone has a license or someone has some type of certification or some type of degree doesn't mean they know everything. And so I think it's always a good idea to do your own research. Now, I have an entire video where I break down the IRS receipt requirements for record keeping. And so I'll link that video at the end of this one or in the description below so that you can check it out right after you finish this one. Okay, let's go ahead and move forward with tax court case number 2, the home office deduction. This case involves a doctor who used a home office deduction, which is another popular tax deduction that allows you to deduct your home office expenses. And so this case is special because it went all the way to the US Supreme Court and it really set the blueprint for other home-based businesses. So let's go ahead and review what happened. So a physician managed his medical work from his home office, but he attended to his patients only at hospitals. So he probably was handling some administrative tasks at home, like maybe arranging his schedule or handling billing or managing his business finances at home while actually working with his clients and patients at hospitals. Well, during an IRS audit, an assessment was performed to determine where the doctor's most significant work functions took place and the amount of time he spent for those functions. And so ultimately, the Supreme Court ruled that the taxpayer's home office was not his principal place of business because he did not perform his most important job functions there, and therefore he did not qualify for the home office deduction under IRC Section 280A. And so if you want to use the home office deduction, then you have to make sure that this is a place where you're actually doing the majority of your business. Okay, moving on to tax court case number 3, I have writing off travel expenses. This case involves a pilot who worked as a real estate broker helping investors to buy and sell commercial properties. The pilot claimed more than $14,000 in travel, meal, and entertainment business expenses for an 11-day trip to Hawaii, where his only business purpose was to scout potential properties for a client. Well, he got audited and the IRS took a look and disallowed all of his travel expenses. So the pilot appealed and it went to the US Tax Court. During the trial, the pilot provided receipts for his meals, his lodging, his transportation, his airfare. So he had all his proper receipts. But here's the thing, okay? Remember, you have to provide 2 things. You need to have evidence and you have to have a necessary and ordinary business purpose. And the court found that the pilot paid for multiple hotel rooms for the same nights. And so why would you need multiple hotel rooms if it's just you scouting for potential properties? But not only that, he had multiple occupants in the rooms, which begs the question, okay, why would you need multiple people with you for you to scout potential properties? And look, if it's me, I would think that if you're taking an 11-day trip to a beautiful place like Hawaii, you're going to be on top of it. Like you're going to have a detailed log of all the locations you're visiting, what you are scouting, who you are meeting with, and so on. You want to have everything nice and tight. But too many people think that they're just gonna fly under the radar and never get audited, and then this happens. He ended up losing the tax court case because he was never able to establish a believable business purpose for his expenses. And to make matters worse, within 1 day of his return from Hawaii, he traveled to Lake Tahoe where he booked a townhome, and that also did not end up qualifying as a business trip. And so sometimes one mistake can lead to the IRS doing a full audit on your entire financial life. Okay, the next case, number 4, is about LLC S corporations. But really quick, before I move on, Can you do me a favor and let me know if you want to see more videos like this where I break down real tax court cases? My goal with this is to help taxpayers avoid losing an audit, not getting an audit, but losing an audit. But I understand that some people may find this information boring, so please let me know down in the comment section below. Okay, let's move on to tax court case number 4 and talk about S-Corp reasonable salaries. This case involves another CPA, Certified Public Accountant. So here's the deal. Another legal way for business owners to reduce their tax liability, especially as they grow, is to convert their business into an S corporation. Okay, this allows business owners to avoid paying an additional 15.3% in self-employment taxes. So needless to say, it is a very popular tax strategy. And so as the sole shareholder of his firm, he decided what services would be performed, where they would be performed at, and exactly what to charge. Well, he got audited and it was discovered that he devoted all of his time to the accounting firm and received about $33,000 as a distribution. At the same time, he never received a reasonable salary. So the court held that both under the weight of tax law and under Treasury regulations, a corporate officer is to be treated as an employee if he renders more than minor services. And so he ended up having to pay about $31,000 for unpaid self-employment taxes, penalties, and interest. And when you think about it, a $33,000 distribution is not really a significant amount of money, proving that the IRS will go after anyone and audits don't just happen to rich people. Okay, let's move on to IRS Tax Court Case number 5, clothing expenses. Now, I'll admit, taking clothing expenses as a tax deduction is a great area, but I think a lot of people are misusing this tax deduction. I even heard a popular YouTuber say that just because he's wearing his clothes in a YouTube video, that he can write them off. And that is simply not correct. So let's review with a case. So a manager of a YSL boutique, which is Saint Laurent, a very luxurious brand, was required by her employer to wear YSL clothing while at work and other work-related fashion shows. And so she ended up spending about $1,600 on clothing and deducted that amount on her tax return as an ordinary and necessary expense. Well, she got audited and went to the tax court where the IRS commissioner argued the clothing was suitable for general or personal wear outside of work and therefore did not qualify for the tax deduction. On the other hand, the YSL manager argued that the clothing was too expensive for her simple everyday lifestyle and claimed that the clothes had never been worn outside of work. Well, initially she won the case as the court decided to take a subjective view and agreed that the clothes did not suit her lifestyle. But the IRS commissioner was not satisfied with a subjective test and appealed, arguing that the court should adopt an objective standard for determining the adaptability of work clothing for general use. And so while the YSL manager had a plausible argument, the court appeal was ultimately successful. And so that's one of the hard rules that we have around clothing expenses or the uniform tax deduction, where if the clothes can be worn outside of work purposes, then it cannot be deducted. Now, there are some exceptions to that rule, and I have an entire video where I break down how to legally write off your clothing expenses. So I'll make sure to link that video at the end or somewhere in the description below so you can watch that right after you finish this one. Okay, moving on to tax court case number 6 is tax-free gifts. This case involves a pastor who understated his income by $250,000. Here's what happened. So the church collected offerings from its members like most churches do, but this church used 3 types of envelopes, which were white, gold, and blue envelopes. Well, the blue envelopes were created for members of the church who wanted to make a contribution to the pastor, also known as a love offering. And so to make this clear, the blue envelopes were not handed out to everyone, but only to members who specifically requested one. Well, the IRS ended up auditing the pastor going back 2 years and found that $250,000 of those love offering contributions should be classified as taxable income. On the other hand, the pastor argued that the money he received in the blue envelopes should be classified as gifts and therefore not taxable. And just so you know, you can give a gift to someone tax-free as long as it is under a certain limit, which for 2022 is $16,000. So the case went to court and it was determined that the gifts given by the members was because of the service provided by the pastor and therefore should be classified as taxable income. So not only did the pastor have to pay taxes on $250,000, but he was also assessed a stiff 20% penalty for substantial understatement of income. Ouch. Okay, tax court case number 7, legal settlements. So what happens when you win a big legal case and you get a settlement? Is that money tax-free or is it taxable? Well, under section 104 of the tax code, you can exclude gross income for the amount of damages you receive on the account of personal physical injuries or physical sickness. But let's review how this can get a little bit tricky with a case. So an ex-employee of the Department of Veteran Affairs or VA filed a lawsuit against the department for discrimination and physical injuries. And he ended up settling with the department and got an undisclosed deposit into his bank account. Well, the IRS did an audit and found several issues, including this settlement deposit. The IRS and the tax court concluded that the settlement was not tax-free because the settlement was based on the employee discrimination and not on the physical injuries that he had suffered. And so section 104 did not apply to him. And so that's such an easy thing to mess up, especially if you don't know the tax code or you don't have a good accountant or lawyer in your corner. Now, here's a very important note that I want to leave you with. Okay, if you get an IRS letter and you get audited, then do your best to substantiate the tax deduction, especially if it's true, because in the best case scenario, you are already doing everything correctly and you will not suffer any consequences. A more average scenario is that you've been audited for a reason and you may have your wages be reclassified. And in the worst case scenario, you could end up being investigated for tax fraud and face prison, which mainly happens when you go out of your way to lie to the IRS, to lie to the courts, to fake documentation, and so on. But in general, I want you to know that all of these tax deductions can be used legally. Okay, the problem isn't the tax deduction. It is following the proper rules around that deduction. That means that you want to make sure you're keeping proper records, or you're ensuring that you have a business use, or you're thinking critically about what you are claiming as a tax deduction. All right, so I hope you enjoyed this video. I can't wait to read your comments and see what you think and see how this video does overall. Please share it across your social medias with anyone you think would learn something from this. Coming up next, I have 2 more videos that I mentioned I will link at the end of this video. So check those out if you haven't already, and I'll see you over there.